Bubbles closing down Monday, December 22nd, 2025. It's about 9 minutes before 7 p.m. Obviously, after the market is closed, Bubbles. And Bubbles, let's check out the VIX. Let's check out the put to call ratios, at least on the S&P 500. Bubbles, should we look at the put to call ratios on the other indices as well? And who is the bubbles for? The bubbles is for people with with $0 to $100,000 of starting cash. That's who the bubbles is for. People with $0 to $100,000 of starting cash. And we're going to help you. The bubbles is going to help you profitably manage a stock market brokerage account, not a crypto account, not a futures account. If it's not a stock market brokerage account, it's a no. It's just stock market brokerage accounts. And how do we do that? Well, we have two main learning tools that we combine together into one learning experience. And those two things are the bubbles and the Gemini Gem. We allow you access to the Gemini Gem, and it is instructed in a certain way that when you interact with it properly, the bubbles will will um will be bubbling. And in conjunction with when you're monitoring the bubbles through our bubbles bubbling on YouTube, every day the stock market's open. Sometimes more than that, but never less. But when you combine the Gemini Gem with the bubbles, you're learning what needs to be monitored. You're asking questions with some really good instruction. And at some point, you will be happily, and it might be a very early point, happily extracting stock market money. I know you'll be happy. I know you'll be happy. I know you will because even making a small amount of money consistently and predictably is so rewarding. And I'm going to help you do that by by not being concerned about the starting cash. The thing that we are concerned with is the starting attention. So where are you paying your attention? Because instead of needing to start with a high dollar amount, I'm going to help you start with a high attention amount. And we're looking at attention on an annual basis, annualizing our attention. And we're focusing that attention, that annualized attention, on extracting stock market money. This is for people with a $0 to $100,000 of starting cash. And we look at these five indices, the relationships with these indices in and amongst themselves, and with all the other tickers that we could possibly put into Thinkorswim, and any other financial asset or any other asset or financial instrument that can or cannot be put in a ticker symbol in Thinkorswim. In these events, my friends, we we become very aware of how we are paying our attention to events, because events, we cannot control events. We can only control where we pay our attention. And we are proactively paying our attention annually to extracting stock market money. So events can either help us or hinder us, depending on how we respond to them and other inherent uh, aspects of these events. But there's a total of, I see 10 different events, 10 different events, and I have them organized, set up, and little two lines, and they make sense. Said, global, state, or down this list that makes sense with each word organized this way. But there's actually, in my view, 10 different events that we should proactively be understanding how our unconscious mind wants to pay attention to these 10 different type of events, 5 to 10, and 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 then and then from there, because our goal is to maximize the efficiency of extracting stock market money, we want to, what is it we do have influence and control over, where we pay attention. And events can be so traumatic that um, without you consciously being aware of it, you are paying your attention to these events without necessarily being consciously aware of it. Something that you develop the skill, you learn how to do it for yourself, and life is way better afterwards. Risk. Risk is something that we need to be aware of how we are paying our attention to risk. And emotional management is the top line, position sizing, and then questions. In this case, the first obvious question is 1% of net liquidity or cash, 2% of net liquidity or cash. What percent of what? Net liquidity or cash? And answering the nuances of risk management in the context of emotional control. And we all kind of, most people, once you're diving into this information, you hear about position sizing. So those three in that order. Again, this is for people with $0 to $100,000 of starting cash. That is it. And you don't need to pay money for this. This is delivered to you for free of money any day the stock market's open, and sometimes more than one day when the stock market's open. Sometimes there might be a little bit more than that on the weekends. But what the commitment is, what you are guaranteed to get is any day the stock market's open, at least one video. And if each video at the most should be about 20 minutes. Like this, I'm going to do my best to every day make around a 20-minute video, and I'm working on figuring out how exactly to position things, but that is what I can commit to you. And you don't need to pay any cash for this education and this learning journey and this transformation. You don't need to pay cash for it. There is a price to be paid, though. There always are prices to be paid in transformation. And the price that you need to pay is attention. You need to pay attention. And you are paying attention. You only have like 100% of units of attention. And you're always paying them. You've annually been paying these units of attention. And what I am encouraging you to do is look at where are you paying them. And I am going to help you, so it could be we annualize our attention on extracting stock market money. And where you pay your attention determines how effectively you can extract stock market money. So we need to be paying our attention to these four indices, not just specifically right at this moment, but annually. Annually. SPY, QQQ, DIA, RUT, monthly charts. We see overall bullish. This month, all-time high in the RUT, all-time high in the Dow Jones. 3 months ago, 3 candlestick months ago, all-time high in QQQ, and also 3 candlestick months ago, all-time high in SPY. So monthly charts definitely look bullish, we do see a slowing of momentum, and we feel that in some of the volatility. And let's look at the put to call ratio for the VIX since it's already here. Total contracts of about almost 750,000, and we are light on the put side, heavy on the call side, which we should expect. This instrument, it's easy to profit from this instrument with a call. And so let's look at and it's a 0.45. Looks very bullish. But is it always like that? I don't know. I will know in about 90 days, 100 days, 200 days, 260 days, 300 days, 325 days, 350 days. 350 days into me looking at this every day the stock market's open, I'm going to have a pretty good idea of what it normally is. And I'm going to be looking at these other ones too, and I will be reporting them to you. So if you can learn to follow along and understand, you're getting stock market education. And if you get that Gemini gem, put those two things together. SPY total contracts 850 8,576,000. Getting starting to push that 9 million mark, which is significantly down from last week. We were pushing 10, 11, 9, 10, 11. That's where we were closing last week. We have more puts than calls. So we have about four and a half, getting closer to it's 4,620,000 puts against our 3,955,000 calls, which is giving us a put to call ratio of 1.168. Put the call ratio of 1.618. 1.16. Let's just call it 1.16. All right, let's look at the Qs really quick. Qs 0.96 put the call ratio under 1. We probably are pretty close to, or just a little bit bullish. Close to, but less than 5 million total. 476,000. And we have 2,433,000 on the calls against 2,334,000 on the puts. So leaning to the bull side. A little more bullish than bearish. Dow Jones Industrial Average. Woo doggies. Bearish. Dow Jones, man, you got the bearish positioning here. Look at this. 2.12. 2.12 on the put to call ratio. 47,000 contracts. 32,000 puts, 15,000 calls. A little more than double the amount of puts than calls on the old Dow Jones. But see, that's what I think. Understanding the nuance between these four different indices, I think that is going to do me a good service. And you're welcome to come along with a ride as long as a free ride lasts. How long will that free ride last? I don't know, but it's going to last a while. I don't know. I don't know. I do know that the put to call ratio on the Russell 2000 is 1.02, man. It's just like, let's just say one. It's one. So let's see how close to neutral the put to calls are. Calls, 31,155. Puts, 31,764. So we see when it like starts getting around this one, it's becoming a lot more neutral in put to call like separation. And then how many contracts today? Almost 63,000. almost 63,000. So again, like I am becoming more familiar with this, and that is our goal. Our goal isn't to take some immediate action, other than our immediate action is familiarity, weaponizing awareness. That is our immediate action. We want to weaponize awareness. What awareness of what? Put to call ratios. And just leave it that broad at first because this is annualized. Annualized. So if you learned in 1 month, if every month you learned about 1% more, annualized, you're doing pretty good. And you do that again next year and the year after that. If not, then you just suck at this game. And you don't want to suck at this game. I don't want you to suck at this game. You won't actually continue to play with me if you suck at this game. I'm trying to help you bring out the dragon inside of you, the fire dragon inside of you. Help them to try to bring that out of you because that's what's in me, and it helps for this type of stuff. I tell you, the thick skin, yeah, it helps for the it helps for extracting as much money out of the stock market as possible. So with that last soapbox sermon tangent, whatever it is, let's move over to where are we at? We are on monthly. Let's drop down to a weekly. Take a quick look at the weekly charts. And weekly charts are kind of all looking the same. We'll go drop down. They're not actually all looking the same. I need to zoom in more, but I've been looking at these charts so much today that I would only be zooming in for your sake and not speed's sake. So here's 3 months from left to right, and each candle, red or green little box there, representing 1 day of trading time. Don't worry about these lines, what numbers they are, what like real detail they are, other than they are moving averages. Just realize they're moving averages, and the white one is the shorter period moving average. The blue one is the longer period moving average, and we're looking for like the distance between them. Here's an example right here. This distance looks pretty good, and we see as these candles move closer down here to this um, teal or blue moving average. These candles move down there. Then eventually, this white line trails behind it. So these are lagging indicators, but they're really good for us to be able to quickly look at four different boxes here and say from left to right, where are the moving averages up, down, sideways? Are the moving averages all kind of tangled up together, or what's going on with them? Where is price action in relationship to the moving averages? And we have overall, we're in this type of market where there's a lot of concern, and rightly so, with these different variables. And the thing that I believe, I think there are some things that are being talked about, they are being discussed, but they're not being discussed to a newbie or beginner's easy exposure. And uh, and I am setting everything up to help you experience the benefits of the awareness I'm alluding to, and even without it necessarily being aware of it, I'm attempting to bless and bestow those benefits unto thee. Anyone that who is unto thee who? Let's be clear on that. People with $0 to $100,000 of starting cash. You don't pay me anything, but you do pay attention. And that attention doesn't really come to me. That attention comes to the VIX. You give it to the VIX. You give it to the VIX. You give it to the four main indices, and you're consciously aware you're doing this on an annual basis. And you're going to look at and see what you can submit to your tax accountant of how much money you're making on an annual basis. And you want that money to be enough to be able to get a loan to buy a house and a car and whatever other items that your beautiful heart desires. And you're able to customize that. So how Could you be a little more proactive with it? Besides understanding, you're going to need to understand what XLF and XLI are. Besides that, I mean, there's a lot of stuff to learn here. XLF, XLI, XLK, XLC, XLP, XLB, and sometimes some of these might be traded out, might be swapped out. But one that is not going to be swapped out for a while, maybe we should just say two, but the main one I'm going to get really in tune with, and I'm going to bring you up to speed with it. The main one right here. Look at the white moving average. Look at this moving average. Look at how price has just climbed this white moving average. Look at how it came over here, boom, rocketed off. All-time high. This is daily. Hit an all-time high today. Is that an annual all-time high? Let's take a look real quick. And let's look at the put to call ratio on it. We are at 20 minutes, so we're going to have to be winding this down and just getting an experience of playing in your Thinkorswim desktop platform, play in it, go into simulated trading, play in it, play, have fun, because if you're playing and you're having fun, you'll train more. You'll practice more. It'll be like practice. And and actually some people like myself realize that it's all training, but if you can make training fun, then you'll want to do it more. So the more playful, the more fun it can be. It is like that. So 2 years from left to right, 2 year, 1 day chart, 2 years from left to right, and 1 day. What do we see with the moving averages? Doesn't matter what their numbers are. We can easily see this one is like, tell you what, this is a 200-day moving average, and this gold one is the 100-day moving average. And then I think the blue, this teal color one is a 9 moving average, and this green one a 20, and the blue one a 50. So but you don't really need to know. Like right here, you don't need to know that exactly because you can tell this one is the on the bottom, and there's this good amount of space between this one here, and then this one, there's still a good amount of space here, and then where does the space start becoming lessened or different? And you can see how they're all squiggly lines here going this direction. Well, let's look at the put to call ratio on that and not, well, since I'll finish this little thing here, and then we have the volume profile here on this, and you see mass amount of transactions here. This is really, really handy. And in a way, from my understanding, it's just another perspective into volume. That's why it's called the volume profile. This is the volume average. This is nice because this running gold line through here gives us an average volume of the last 50 days. So these events right here with these big spikes in volume, that's giving us information. And it probably this correlates with shares transacted, volume of shares transacted. That tends to act like a magnet or repelling and attracting. But the put to call ratio, let's get over there as we're winding this up. Put to call ratio of XLF financial ETF, financial sector ETF, is 0.929. And there was a total volume today of 122,000 with almost 59,000 puts and a little over 63,000 calls. So it's got more of a bullish tilt to it. And that's what we want because the stock market is a mechanism that tends to go up over time. So we're looking for ticker symbols that tend to go up over time. This is 2 years. It's tended to go up over time. Just look at the red line. Look at the red line. It's tended to go up over time. And so let's look at a different. Here is 5 years. Over the past 5 years, we went up here and then we kind of went sideways through this time. Down sideways. It was a trading range and it was a trading range to the downside. Then around here, during this time, it's definitely going more sideways, and 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 starting to creep up. And then here, obviously, it takes off. And then up around this area, we have this pullback here, and it gets down to the this 20 period moving average and spikes back up, goes above this 9 period moving average, stays over that, testing these highs here, and comes significantly corrects back down here. With as it got the this time, it's been a long time since the price has been close to the 100-day moving average. So last time it was around here. Once it went in the bull phase, it was testing that 100-day moving average, and then this candle giving a clue that of what might happen to the upside. And over time, it's here, and we see its journey of pulling back again to the 50-day. So instead of pulling back to the 100-day, it pulls back to the 50-day. And now the moving average is it. Think from this powerful bull candle followed by of this 3 days of price moving up, which now we have a slowing momentum after this big bull candle here. Slowing momentum, two candles in a week that were a little smaller, but this one bullish right now, and yeah, it's a weekly, and we're just getting started on Monday. So we'll see how this plays out on Monday on once the weekly candles fully close. And here's a look at the max amount of years from left to right and monthly chart. So let's call it let's call this quits for the moment. If you have any open positions, then you want to come up with a plan to deal with those open positions. And if you don't already have a plan with them, maybe your open positions, everything is good. But if you have open positions and everything is not good, you need to, it would behoove you. It's not that you need to. You can not do it and stuff and experience the consequence of not doing it. Or you can do proactive things and experience the consequences of doing proactive things. It's just a matter of learning to pay your attention to the things that are going to yield you results that you're looking for. Specifically here, extracting money out of the stock market. So I'm 7 minutes and almost 8 minutes over the time I had allotted to this. I hope that this has been the most enjoyable video because I think I'm getting closer to dialing in how I want to be delivering these every day the market's open for you videos. Amen.